When optimism about a Federal Reserve rate cut surges, it doesn't just boost market morale. It can reshape the entire investment landscape. Yet, this promising outlook is colliding with political uncertainty in France and Japan, setting up a week that could redefine expectations for stocks, currencies, and commodities. And here's where things really start to split opinions. Are central banks becoming hostages to domestic political turbulence? Global stock markets began Monday on a strong note, with both Asian and European indices showing clear gains. The US S&P 500 futures also nudged higher by 0.2%, hinting at a potential revisit to previous record highs, the kind last seen after disappointing US jobs data. Those numbers not only shook up Wall Street, but also convinced many investors a September rate cut from the Fed is essentially locked in. But this is the part most people miss. Such economic optimism is playing out against a backdrop of political drama that could easily upset the apple cart. In Japan, the sudden resignation of Prime Minister Shigeru Ishiba sent shockwaves through markets. The yen dipped, and Japan's Nikkei soared nearly 1.8%, driven by the view that uncertainty at the top will make the Bank of Japan reluctant to hike rates soon. Traders are now closely watching to see who will step in as the new leader. Will it be someone like Sanae Takaichi, known for her criticism of tightening monetary policy and support for more government stimulus? If so, don't be surprised if Japan's central bank stays dovish much longer than expected. Meanwhile, political instability in France is also stirring up anxiety among investors. Embattled Prime Minister Francois Bayrou is facing a confidence vote, one he's widely expected to lose. If that happens, France could be hunting for its fifth prime minister in just 3 years. While French markets have calmed somewhat since Bayrou called the vote last month, the underlying uncertainty hasn't disappeared. Should President Emmanuel Macron try to appoint another prime minister, or risk calling the new parliamentary elections? Neither path is straightforward, and both keep investors guessing. Add to this the looming series of French debt rating reviews. European markets, especially French stocks and bonds, won't be breathing easily anytime soon. Over in currency markets, these twin pillars of uncertainty, Japan's leadership crisis and France's political upheaval, are holding the US dollar back, despite weak American job figures that practically guarantee a Fed rate cut. Paul Mackel, HSBC's global head of FX research, says the latest jobs report opens the debate. Is the US job market just cooling, or is it genuinely deteriorating enough to warrant even faster rate cuts? If things are worse than they look, the dollar could lose ground against other currencies, assuming Europe or Japan don't supply even more drama. Last Friday, the dollar fell to its lowest level in 6 weeks against other major currencies. On Monday, it continued to slip against the Swiss franc and certain Antipodean currencies, while the euro was just fractionally higher and the dollar ticked up against the yen. US Treasury yields, which had plunged after the jobs report, steadied somewhat, the 10-year yield now marginally softer at 4.08% and the rate-sensitive 2-year yield at 3.50%. One crucial moment still lies ahead this week, Wednesday's release of US Consumer Price Index (CPI) data. If inflation comes in hotter than expected, it could squash hopes for an especially large Fed rate cut. Meanwhile, the European Central Bank is set to meet Thursday, but most analysts anticipate a second consecutive hold on rates, keeping the suspense contained for now. But don't overlook the action in commodities, a sector quietly delivering eye-popping returns. Gold notched yet another record high, soaring to $3,616 an ounce. Its meteoric rise, up 37% so far this year, after an impressive 27% jump last year, demonstrates just how much investors are seeking safe havens amid all this volatility. And oil is getting more expensive too. Prices advanced after OPEC Plus decided over the weekend to slow the pace of output increases starting October, anticipating weaker global demand. Brent and West Texas Intermediate crude each rose 1.6%. Here's the kicker, a controversial one. Are central banks losing their grip, forced to react to headlines and scandals rather than data and fundamentals? Should monetary policy be insulated from politics, or is some interplay inevitable? Drop your thoughts and disagreements in the comments. Are we witnessing the start of a new era in central bank independence, or just a temporary blip?